Let's talk about one of the most confusing and honestly, one of the most important decisions you're making in your business. You probably don't even realize it. If you've ever looked at your numbers and thought, wait, how am I profitable but I have no cash? Or feel like I'm doing great, but my financials don't reflect that. Promise, you're not crazy. You're looking at your business through the wrong lens. And that lens, it's called cash versus accrual accounting. Most business owners don't even know which one they're using. And yet it's completely shaping how you see your business, how you make decisions, and how confident you feel in your numbers. Here's the truth I've learned after 11 years working with thousands of business owners. The way your numbers are reported will either bring you clarity or create confusion, stress, and energy suck. In today's episode, I'm going to break this down in a really simple way so you can actually understand what's happening behind your financials, why your profit and your cash don't always match, and how to choose the right approach for your business based on where you're at right now. I want to help you stop making emotional decisions based on numbers that aren't actually telling you the full story. In this video, I want to talk about the difference between cash basis accounting and accrual. This is an important decision as a business owner and deeply affects the way that we look at your bookkeeping, the way that we complete your bookkeeping, and really the administrative burden for you as a business owner. I want to walk through exactly what cash basis and accrual basis accounting is, and then how this would be applied to your business. When a business has cash basis accounting, that means that every dollar that comes into the business, every deposit that is made is considered revenue or sales the minute that the cash is actually deposited into the checking account. For instance, if you made a sale on October 31st and you rang your customer's credit card on October 31st, but the actual deposit wasn't made into your account until November 2nd, it would be considered sales for your business on November 2nd and not October 31st when you actually rang the credit card for your client. This is important because business owners who are cash basis, it's really important that you understand that your sales might not always match your point of sale system. It might not always match the time that you write checks. So cash basis accounting means that you are going to consider revenue or sales the day that money comes into your account. Now, this is the same for your cost of goods sold and expenses. For a cash basis business, you will consider something an expense when the money actually leaves your bank account. So the moment that the money leaves your bank account, that is when it is considered an expense. This is very different from accrual basis accounting. I don't want to use too much accounting language here in this explanation. So I'm going to really make this a basic explanation of accrual accounting. What we're doing in accrual accounting is that we're trying to match the expenses as close to the sales as possible. This means that when you're out buying inventory or you're paying for an annual membership for a subscription, you're going to put that on the balance sheet. So your inventory and your prepaids, your accruals, those are all going to live on your balance sheet. When you actually sell your product, you're going to relieve inventory and you're going to move that expense to the income statement. Now you're only moving the value of that piece of the goods that you are selling. So if you have $20,000 sitting in inventory, you're only going to move the value for selling one individual piece of your product to the income statement. Now, this can also add complexity in your cost of goods sold as well as your expenses. If you're paying for a long-term annual subscription, you'll actually put that on your balance sheet. You will not see the income statement be affected when you make that long-term payment. So let's say you're paying $5,000 for the year. You're not going to see $5,000 on your income statement the day that that expense went through. You're going to actually divide that $5,000 over the whole 12 months, and you're only going to see 1/12 of that $5,000 on your income statement each month. The rest of the balance is living on the balance sheet. Now, what do you pick? Like, how as a business owner do you decide between cash basis accounting and accrual basis accounting? Here at Kickstart Accounting, I would say probably 90% of our clients choose cash basis accounting. And I'll say that this is definitely the simplified version of accounting, especially for small business owners. Now, that's not to say that at the end of the year, you might count your inventory and make a journal entry at the end of the year for your inventory that's sitting in a warehouse or in your basement. But day to day, month over month, as a small business owner, you are considering income when it is received into your bank account. And you're considering it an expense at the time it's leaving your bank account. Now, the pro to cash basis accounting is that it's simple, it's easy. You don't need a lot of administrative support in cash basis accounting. Like I said, you'll do a one-time per year count of inventory, and that's more for tax purposes at the end of the year. But month over month, you're going to see that cash inflow and outflow. One of the biggest questions that we see from clients is, I see my profit and loss statement, but I don't understand where my cash is. And having cash basis accounting is going to help mirror the profit to the cash impact of those decisions as closely as possible. Now, some of the cons to cash basis accounting, your biggest one is going to be if you have a large amount of inventory that you are purchasing in 1 month, you're gonna see the impact of that on your income statement the month that it's purchased. So you might not sell that inventory until the end of the year, and it's sitting on your profit and loss the month that it was purchased, and you might not sell that until later. So the con of this is that you're going to see big swings in your profit and your loss. So months that you make large inventory purchases, you might have a loss during those months. And then later in the year, when you have the revenue for those expenses, it's not matching the sales. And so you might have a big profit. Over time, your profit and your loss is smoothed out over the year, and you're not feeling the impact of timing over long periods of time. But month to month, you're definitely going to see some swings. And so that's a big con of that. When our clients come to us and say, hey, I'm thinking about moving to accrual accounting, I want to walk you through the big considerations that I want you to think about. And the biggest one is, do you have the time and the support in order to be able to accurately monitor and track your inventory and your cost of goods sold? So we need to have the systems, time, and support to be able to track every inventory dollar that's sitting on our balance sheet. And then as we sell the pieces of inventory and we relieve inventory and we move the cost of goods sold onto the income statement, we need to know exactly how much we paid for each one of those pieces. And there are multiple pieces involved. We need to know the calculation and how much each piece is worth so that we can relieve inventory and accurately move it to cost of goods sold. So the pros to accrual accounting, the biggest one would be the accuracy of the accounting. I love in accrual-based accounting that you're going to match the timing of the expense to the revenue. So you can see true profitability month over month because you're matching the revenue and the cost at the time that the sale is happening. Some of the drawbacks to accrual accounting could be that we put our business at risk of having large amounts of inventory on the balance sheet. I think because as small business owners, we don't spend as much time analyzing and understanding the balance sheet, that those dollars are sitting on our balance sheet and we might not be seeing them with the same level of detail and care. And so if we're going to move to accrual-based accounting, again, I want you to be able to have the systems, the time, and the support. So you as a CEO need to be ready to commit to monitoring that inventory every single month. Every time you're purchasing a piece of inventory, we're monitoring that inflow closely. We're tracking it. We're doing regular inventory counts and understanding that cost of goods sold every time we sell a piece of inventory. It's a big commitment for a small business owner. Why am I talking about this? And why am I talking about this right now? There is a big impact on your tax return and the way that you do accounting. I recently did a discovery call and I was talking to a business owner who her tax accountant had moved her to accrual basis accounting last year. She was very frustrated and very overwhelmed. When I asked why the tax accountant had did it, she said, well, he was able to do a journal entry that was going to save me a ton of money on taxes. So she saved money in taxes in year one, the time of the change, but she's going to pay those dollars in taxes this year. So we really just moved the issue 1 year later, and she actually had more cash last year to pay the tax bill than she does this year. Unfortunately, this business owner is now having to carry the burden of tracking the inventory, of knowing what's in her warehouse, what's in her store. And she doesn't quite have a handle in her current system to be able to track that level of cost of goods sold and that level of detail. And so now she's left feeling like, gosh, I don't think my financial statements are accurate. I don't think that the amount that's on my balance sheet even matches the amount of inventory I have in the store. And I don't think any of my profit was actually right this year because I wasn't relieving the correct amount of cost of goods sold. Now, I'm not saying that there's never a time and place for accrual basis accounting. I think as businesses grow, it can be an amazing tool. So here at Kickstart Accounting, we practice accrual basis financials, but we have the money team and the support that allows us to be able to run that level of financials. I would not do that 5 years ago when I didn't have the support that I have today. So it's a big decision for us as business owners, especially at this time of year. So if you're having a conversation with your money team, your CPA around cash basis of financials or accrual basis, I want you to really seriously think about those options and the best choice for you as a business owner. Remember, a tax saving strategy this year that's really just pushing the expense to next year isn't a tax strategy. So have the conversation with your money team and choose the best accounting process for you and your business. If you need help making this decision, navigating this decision, or undoing some of the processes that your team might have put in place for you and your business over the years, this is exactly what we do here at Kickstart Accounting. We help our clients navigate these type of decisions every single day and determine what's the best solution for them in their business now. If you need support, you go to kickstartaccountinginc.com and book a call. Our team is ready to serve you and be part of your money team.